Good morning, everybody. We'll get started in just a minute. All right, it is 10 o'clock. Good morning, everybody. Welcome to the April Communities of Practice. As is tradition, we're going to start out with our congratulations, celebrations, and shout outs. We're going to recap March's fraud detection and prevention discussion. We're going to look at the data acquisition calendar and review some of the upcoming PD and grant opportunities. And then Austin will provide us with an ESEA federal programs update. Lisa will provide a special education update. I'm going to dive into some of the legislation that happened throughout this very busy legislative session. And then Austin's going to round us out with some GRA updates. So diving right on in for congratulations and shout outs. So ISU, the College of Southern Idaho, and Eastern Idaho College were all recipients of a $3.5 million grant to help redesign and simplify their admissions process. We're very excited to see how that works for all the kiddos who are about to graduate. And then a big one to our very own Lisa Pavelski Rosa in her new role. She's been promoted within the department as the Director of Fiscal Policy and Accountability. So we're very excited for her to be able to jump into that and start making some big changes. If you know anyone who's very excited about working in SPED and maybe looking for a position in Idaho, we will be posting her position as a backfill shortly. So keep that in mind if folks are looking for a great gig and some great people to work with. Next, we'll look at the fraud webinar we had last month. And then again, what is fraud? And that's the material false statement that is knowledgeable at the time the statement was made. And we're using that false statement to kind of create some sort of damage to a victim. And generally, we see these as disclosure fraud, as in not showing if you had losses or significant revenues, or simply a misappropriation of your assets, whether that's cash or other assets. Now, the rationale behind this is that there's some sort of pressure, whether that's internal, external pressure, money troubles, that cause someone to think, hey, there's an option. There is an opportunity for me to commit some sort of fraud. And then there was the rationalization of that opportunity and the taking of that opportunity as something that maybe they deserve or maybe something that they were entitled to. All those are requirements to have that kind of fraud mindset and people to take that next step. These aren't generally people who commit fraud, and it can happen all over the place to people you wouldn't necessarily expect. So some red flags are those accounting, analytical, operational, and behavioral anomalies. Those are things we want to watch out for, and why those internal weaknesses are so critical to helping prevent fraud and make sure that things are going correctly and people aren't taking advantage of situations. And again, this can happen anywhere to many people, so we just have to have those internal controls to make sure that everything is on the up and up. Now, if we're looking at Benford's law, it's a really interesting study looking at the occurrence of numbers. So we're expecting to see ones, twos, and threes are going to be the most common, with one by far the most common. Once you start getting down to 6, 7, 8, and 9, those digits are way less common. So if you're looking at a data set and you think, boy, this seems doctored, it may well be if you're starting to see a whole lot of eights in those numbers. We're expecting, again, to see a lot of ones in most of our numbers. Now, as far as the mandatory disclosure, 2 CFR section 200 spot 113 says that subrecipients, such as districts or other LEAs, must properly disclose in writing the credible evidence it has of violations tied to a federal award. So again, this has to be in writing, it has to be timely, and it has to have some sort of credible evidence. Now, these disclosures go to the federal agency, the Office of the Inspector General, and the state pass-through entity, which in this case would be the Department for our education things. Now, these reportings show that you're compliant with understanding the CFR, not necessarily that you are guilty. And again, we're looking not necessarily for smoking gun, damning credible, or damning and specifically definitive evidence. We're looking for something that is reasonable, something that makes you kind of have pause. And at that point is when you're into the mandatory disclosure. We're not looking for the absolute definitive, this person can go to jail type of evidence. We want credible evidence. So what's on your radar? So we're going to jump down into the middle of this here. We've got your summer food service program and your fresh fruit and vegetable program application or renewals are coming up at the end of the month. as well as at the end of the month, the second from the last, notifying your county clerks of your budget hearings. And also your IC transparency upload is coming at the end of the month as well. Now, jumping into May, there are quite a few number of things here as well. We've got another IC data submission in the middle of May that's coming in. You've also got some determination items that are going to be due over to the special ed folks at the top of the list there. We also have your McKinney-Vento student data collection coming in at the middle of the month, and your staff assignment credentialing reporting is going to be coming in. Then down towards the bottom, we've got your NSLP program review and your significant disproportionality notification. So a lot of things coming in as we kind of start to wrap up the end of the school year and start rolling into the next items for the next year. So some housekeeping. We've looked at we looked at the top two already a little bit in the past year, but the National School Lunch Program has mandatory training, and that is open. So that's going to be predominantly June, July, and August, and it's spread out throughout the state, so you can be able to access those training programs. I'll hit on the first and last one on this slide. So the 26th Driver Education Conference is being held again across the state in both Idaho Falls and Boise, and then virtually in the middle of June. And then at the end of the list here, we've got that Secondary Literacy and Dyslexia Summit on June 13th here in Boise. Next, I'm going to kick this over to Austin for some federal programs updates.
Folks, so just a quick couple of updates. CFSGA workshop is here right around the corner. We'll be in Boise on the 28th, in Pocatello on the 6th, and in Coeur d'Alene on the 13th. If you'd like to join us, there is a link embedded in the slide deck that we'll be sending out. You also will likely have gotten some emails from Alejandra Castaneda, who's on our team, inviting you to join us for those workshops. So come on out, hang out with us, and hear about what the CFSGA looks like this year, what may have changed, what some hot topics are for revisions, that sort of thing. That email from Ali had an agenda in it, so if you're curious what we're going to be talking about, feel free to have a look at that. Secondly, our allocations are all here. We've seen some minor changes in Title 1A. Go ahead and go to the next slide for me, Rob. So allocations for 1A have only slightly changed in totality, but there have been some shifting within the Title 1A formula, meaning that this year a lot of our smaller LEAs and our high poverty LEAs will have seen an increased allocation in previous years, while our lower poverty LEAs and larger LEAs may have seen a slight decrease, but those details will be available in the CFSGA once it's live. Additionally, we've seen an increase in funding in 1C and 3A funding, so your per pupils will have generally gone up. Obviously, if your migrant or EL population decrease significantly, then you will not see as much of an increase or maybe a decrease, but generally speaking, those are good news. And then for Title IV and Title II, they're about steady funded, so any changes in allocations on those guys this year will be predominantly based on either the changes in your low-income population, and enrollment for 2A, and then what your previous year portion of the Title 1A allocation is for 4A. So 1D and 5B are still pending, but seems like a lot of you folks are still in the conversation about applying for SURSA funding and that sort of thing. So no sweat on those guys just yet. And then finally, next slide, big news. The CFSGA is planned to go live Monday, April 20th. We're shooting for 8 a.m., but Lord knows with a launch, sometimes things go a little bit delayed. So we will send an email out to everybody, letting you guys know, hey, the application's open. We're also going to include a copy of the GRA manual that's recently been published, and we're going to hope to follow up with a copy of the CFSGA manual that's been produced, specifically for this most recent version of the CFSGA to help you navigate some of the new features we've added in this year. But beyond that, I'll pass it off to Lisa. Thank you, folks.
Thanks, Austin. Well, Lisa will be up next.
All right, good morning, everybody. So now you have an update for the IDEA application. So first, we're going to talk with the state application. We have to apply for the IDEA funds. So we have a mandatory 60-day comment period that we have posted with some links here for folks when you get this. And also, if you want to join a public Zoom hearing, we kind of go over the state application. The state application is very initiative-based. It's a block kind of application, if you will. We did notify everyone via email with all this information, but this is just another step to make sure you guys are aware. If you do have comments to be made, please provide those before the May 8th deadline. Next slide, please. So with that, some folks have asked me, well, what does that include? So some of the state regular investments that we make are to help support statewide technical assistance and training for our special education field folks. So the people providing the direct services need supports and training to help them to make sure that they can adhere to the IDEA and everything that it offers for our students. And so here's some of the bullet points that talks about what those investments are. We also help provide funds to support our School for the Deaf and Blind, Juvenile Corrections, and the Department of Corrections for the students that they serve at their facilities. And then there are some other required things that we have to do, such as monitoring and complaint investigation work and things like that, mediation services. So all this, I have our little superhero here, is to help make sure that you guys are staying super, feeling super supported. Next slide, please. And then for our LEA application, we'll be providing an online training. I have a link here, if someone can copy that in the chat for me, that you can register for our annual training. I just do it via Zoom. We do have a slight couple of revisions. The way it looks is a little bit different. They've done some enhancements to make sure that our application is also more accessible for screen readers and whatnot. So we're going to open probably mid-May. We're a bit behind the other CFSGA as that we have not received our state allocation for the 26th federal budget. So based on everything we know, it's still going to be fairly flat for us in Idaho. Lots of different pieces go into that, but it's based specifically on some of the poverty rates and some of the child counts for special ed from the 90s, and then it's split out across all the 50 states. But make sure you register here. Just a reminder, the main part of the allocation process to LEAs is based 85% on total student enrollment, not your special ed kiddos, just total enrollment, because any student could potentially qualify for services. And the other 15% is tied to your low income distribution, and then a small little piece for base allocations. So hopefully I will get those out to you still in April. As soon as we get those here, we will start distributing them out and put the tables out so you guys can throw those in your budgets before they're due in May to your board. And then let's see, next slide, please. Something else I always remind folks, this is the time of year where we're right between applications. So I haven't opened up the new one. So if you're trying to review what's my maintenance of effort and what am I trying to close out this 25-26 school year at, if you open up the 25-26 school year application for IDEA, you're going to want to go to maintenance of effort section 2, because that is what you closed out last school year ending in June 2025 with, and that will become the new yellow highlighted section of the big table that will show up in the 26-27 app. But so right now, if you're looking, make sure you're looking in the right place, not at the old threshold table, because that would have been the 2024-25 school year. So we want to make sure that you're in the right year when you're looking at that to determine, make sure you don't have any penalties, want to make sure we close out accurately. Next slide. All right, so high needs fund, good news, we did pass that. So for all those of you who didn't remember, let me know if you have questions on that. But we want to just put some bullets in here about what that entails. This is not going to be a standard distribution through school finance where everybody just gets a little bit of the pot. The $5 million is going to be application based. So basically there's a couple different tiers. I'm calling them tier 1 and tier 2, where you have student costs between 30 and 80K. The first 30 is on you, but between 30 and 80K, we could fund potentially up to 100% of that cost. And then for students that are over that $80,000, and yes, they are there, those could be funded at 80%. But really, we're looking at a maximum $100,000 per student. Want to make sure that everybody has a chance to get used to the application, help us improve it. So we'll have a couple versions of it, but we're going to try and open those up in the early fall, but applications will be due in June. So you'll basically start your application, fill it out, start doing the work behind that, and then you'll have the final version that'll be due in June for us to then review to do a special distribution in June to you all. Next slide, please. So with that, it is under construction. We are in the beginning phases of trying to develop the way to do this. But really what it's going to come down to is cost accounting for a student, which we're not used to doing because we have several teachers and staff that may serve a special ed student. But we're going to have to cost account that out to a student cost to be able to say, what does this one student cost? So with that, you're going to need to team up special ed and business officers because your special ed directors are going to be able to go on the hunt for these costs based on what they can find in their IEP system. So they will know these students. They will know the students that have the most types of services, and then they'll be helping you with understanding whether or not they're Medicaid eligible and the whole 9 yards. There'll also be the chance to help recoup some of those unreimbursed transportation costs. So if you would like to help us in this process for the design testing, please reach out to me directly. Super excited about that. And we really want to, have everybody from different types of accounting systems help us to find the best way to run reports and those types of things to disaggregate, to be able to find what a single student cost will be. And that's it. Thanks.
Thanks, Lisa. Appreciate your help on the High Needs Fund. So we're going to jump into what happened with the legislature. They've finally sine died, but first we're actually going to look at federal side. So we're going to look at the proposed budget. So the president did release their budget proposal for federal fiscal year 27. This looked fairly similar to the 26 proposal. There's some level funding for Title I at $18.4 billion. There was an increase on IDA Part B grants to states by about 1.167 billion. So there'd be more coming in, and then also some kind of consolidations going on through a couple of the other components in IDEA programs. And then also an increase in the charter school grants by $60 million. And again, these are going to be national increases. So what that trickles down to us might look different, especially since this is a proposal and it still has to go through Congress. So kind of mirroring what the state just went through on a much faster scale than what Congress does. This is kind of the initial output that the executive is looking for. So we'll look at the timeline real quick. So the Congressional Budget Act of 74 requires that the Congressional Budget Office, the CBO, submits to the budget committees their annual report. Generally, that's going to happen in January or February. And then by the time we get a little bit further into the year, so yesterday, the CBA requires that there is a resolution that will kind of show what the budget is going to be, and that's kind of a starting point for them to kind of look at before they begin to actually outline what the fiscal year is going to be for October. So these budget resolutions have to be considered in each of the chambers before they are kind of agreed upon. So there's also a conference committee that is kind of the one that helps bridge the gap between what the House and the Senate are looking at. In the state of Idaho, we have a joint committee that does that, kind of cuts out some of those in-betweens. But on the federal side, there are some serious differences between what comes out of the House and the Senate. And then they are not able to do considerations of revenue, spending, and debt limit measures until they're able to get that budget set up. So they are required, unlike Idaho, to have their budget set up in terms of what they're going to do before they start allocating some of those items. Now, when it comes to the allocations and the appropriations process, so Congress, as the controller of the purse, is the one who's going to be allocating those spending amounts. So the Congressional Budget Act does require that the House and the Senate Appropriations committees subdivide their amounts to their subcommittees. So they're going to be allocating those items and then trying to develop what the appropriation is. And like the state of Idaho, federal executive agencies are unable to draw any funds out of the Treasury until they have that appropriation, that thou shalt be able to use language that allows them to have kind of a hard limit on what they're able to spend. They can't spend over that appropriation, and they have to use their appropriation in line with the language that's provided by Congress. So somewhat similar in that regard there to what the state has as well. So when are these budgets going to be set? Great question. Your magic 8 ball is probably going to be about as good at this as anybody is. So we do have that deadline on appropriations of September 30th to align with the federal fiscal year. But often these things get bogged down. So the Congress has the ability to do a stopgap funding bill called a continuing resolution that will extend the current spending amounts longer. So this kind of punts some of those items out a little bit and allows them to take some time, especially since we have midterms coming up. There's a lot of variables involved in the politics of these things. So on the federal side, We'll see, and we'll keep you updated as much as we see. Now, on the state side, we have hard numbers in, and we have a really good idea of what our general outline is. We've talked a bit before about our current year, fiscal year 26 budget. That was held more or less harmless. So we were able to report on that before. So we did have a $22.4 million reduction, and that is going to be allocating based off of the differences in support units that were expected primarily. So we revised those support units down by a couple hundred from what was appropriated the last time, this year last time. And then, of course, if we're off on those appropriations, those funds can be pulled from PSIF, so we get you the accurate amount of money that's due to you all based off of your costs. Now, for fiscal year 27, there is a different bill. So we're going to have really three bills that outline this. Our 26 bill, our maintenance bill, and then our exception additional bill. So when it comes to our maintenance bill, those decisions from 26 were built in. So we kind of carry forward where we were in 26 going forward into 27. So now the career ladder amounts were going to remain the same, and those minimums still do apply for your R1, your professional one, and your AP1 as well. That 6,359 number is still stuck in appropriation bills. They did not put that in a statute this year again, so we do have to watch out for those minimums being adjusted there. And similarly, we do still have the open enrollment requirement. So this language is directing the State Department to withhold funding to any districts who do not meet with those compliance standards for your November payment. So quite a bit of a stick that they're putting in behind that open enrollment portion. Now, when it comes to insurance, the governor had recommended two different ways of appropriating insurance increases. One for those who are on the state plan and one for those who are not. And now the ones that are not on the state plan, it was a 10.8% increase, and that is based on an average of everyone's costs. So when it comes to this year, they went ahead and appropriated two different amounts per, depending on what type of insurance you're using and where that lands. On the plus side, though, we do still have the language that allows any of those excess costs to be treated as discretionary funds. We are also required to be reporting to the legislature how much those premiums cost, how much the premiums are increasing, and what are in revenues and expenditures from those fund sources for being used for health insurance. So they're adding quite a bit of work to the department as far as reporting out what's going on out in the LEAs. Now, as far as our enhancement budget or our kind of extra items, the line items that were added to our budget, that came in Senate Bill 1444. So again, public schools were exempt from the large 5% effective holdbacks that were hitting all other state agencies. So we do still have statutory adjustments for things like career ladder transportation. Most of those statutory items are going to be picked up by PSIF, with the exception of IDLA, which had some language put into its bill that requires it to not be hitting PSIF and using some of their own cash reserves. So our discretionary funding was flat, and then the per support unit amount of discretionary funding for virtual schools was decreased by $3 million statewide. So that's how they came up with that number, $19,723. So as part of that, there's also some virtual enrollment and attendance requirements. So this is something all LEAs should be aware of, is if you do have a virtual program within your school, you need to have a special virtual building for it. So that is the way we're allocating which students are going to which building, and those do have to be reported in IC. Additionally, the legislature did grant the request that we put in to change how we're doing some of our ELL funds. So there was $2.25 million that we were doing contracts internally as the department on behalf of LEAs. We had pitched to have them just send that directly out with your ELL distributions, and the legislature agreed in that case. So if you have ELL students, you'll see your distributions go up a bit this year. Transportation's a fun one this year. So House Bill 396 of last year removed that $7.5 million reduction that hit proportionally every school's transportation budget. So for fiscal year 26, for this fiscal year that we were reimbursing you on for last year's expenses, that $7.5 million is going to be removed. But then they put an appropriation language instead of actual statute that we're going to keep that $7.5 million reduction. So for next year's distribution, for your reimbursing you all for your costs for transporting kids, we're going to have that $7.5 million again. So a two-step here, and we're going to see what that looks like because this is a one-time adjustment. They could continue it next year. We will see. Now into content and curriculum, we had some adjustments through House Bill 599 to change how that $1.6 million of our digital content and curriculum is distributed. Now we're going to be going through an application process and we're going to provide some information on how to apply for those dollars. So it's not just first come, first serve this year. Now, on special education data, the departments now are going to be required to pull from our current sources of data. How much are you all spending? And there's a lot of data that we're going to be looking at here in terms of where you're spending and your revenues coming from for SPED kids. This is going to be something that we're going to be working directly with the legislature on and trying to provide that information, recognizing that, again, a lot of this is kind of rolled together, so it may be hard for us to tease some of this out. For the state budget, we did still have that 5% adjustment. We did get the carry forward for our Millennium Fund for things like the After the Bell and our SRO funding, as well as our Career Ready students. So anything we don't use this fiscal year carries into the next fiscal year. We had some additional money for our school bus camera fund, and then they revised our language that allocated our smart literacy funding now to not include administrators. So this is primarily going to be focused on teachers and other staff, not administrative folks. We've got a lot of bills to jump through, but I want to make sure we save some time for Austin. So I'm going to glaze over a few of these. Most of these we have talked about a little bit before, but I'll go ahead and hit on House Bill 531, which allows additional epinephrine delivery systems, so it's not just EpiPen anymore. And then also we're going to look at House Bill 934, which changes some of the eligibility requirements for those House Bill 93 kids. So this does allow them to participate in their non-academic activities at public schools and still be able to be eligible for those tax credits. So if you have some reporting issues, that may be something that we're going to be looking at. On the second side, House Bill 940 was the bill that survived in terms of changing how IDLA is funded. So this removed custom sections, it removed driver's education and your K through 5 courses from IDLA, and it also capped how much the state is going to be funding those courses to $445 per course. So some big changes that are happening there on IDLA. It's going to definitely impact how you all are able to access those programs. And Senate Bill 1438 cut $13.5 million of funding from IDLA, and it will not allow them to take piece withdrawals for fiscal year 27. So this will limit the number of kids they're going to be able to serve, and that will likely have an impact on how you all are going to be working with that program and integrating it into your schools. Lastly, on here, I'll note House Bill 822 does require the parents be notified of gender identity issues that students are seeing. And if those are being reported to staff in the schools, those are going to have to be reported back to the parents. Now, on my third and final one before I pitch it over to Austin, we do have House Bill 628, which modifies the driver training restrictions for parents in IDLA. So that changes from having only rural parents being able to do those teaching of the driver's education in-person programs. Now that's open to any parent throughout the state. There's also some adjustments to how do we count how CTE instructors are authorized and how are they placed on the career ladder between House Bill 832 and House Bill 849. So those are going to be some changes that are going to come your way if you've got those CTE staff. House Bill 883 provides for earned autonomy for high-performing schools. Now, this is not just going to be charter schools. It is open to brick and mortar schools as well. So a pretty big change for some of the original ways that that was being looked at from the legislature. And then lastly, I'll highlight Senate Bill 1412, which requires a law enforcement organization to investigate anytime there's an allegation of abuse, abandonment, or neglect within the school system. So these are no longer things that can be done internally. We have to involve law enforcement officials in that regard. So with that, I will pitch it over to Austin for our professional development in 30.
Folks, on a go over driving from Rob. So I got two topics for today. What I'm working on is going to be first and foremost, an overview of what all has been discussed for the GRA manual, what's been updated, what's been changed, kind of some highlights. One more quick plug, the fact that we put together a GRA manual for you guys. It's been updated with more comprehensive guidance. And then we're going to pivot from there into kind of a sneak peek of some of the new features in the CFSGA and how that's going to affect the way GRA management is encouraged, or how GRA management may change in the upcoming year, and how we're measuring carryover. So first and foremost, the updated CFSGA manual, GRA manual. As often as I throw these acronyms around, they still bleed together. Rob should be able to throw a direct link to the GRA manual in general chat for you if you're curious to have a copy of it right in front of you. But if you want to find it on your own, you're a strong, independent individual, you want to go seek it out yourself, you can find the manual in two places. If you open up the GRA itself, it'll be directly linked to the user manual text under the documentation header. Additionally, you can go to the State Department website and open up the budget and grant fiscal page. Under resources there, you'll find GRA manual updated 2026 in that list of items. If you open up the manual from that link on our state website, you can bookmark that link and you can constantly reference it that way, or you can download it completely offline from the GRA link there. Either way you want to do it. What the manual contains, for the most part, for the first half, is generally old content. It was part of the existing GRA manual that was primarily for setting up a brand new user. How does the app work? How do you log in? How do you set up an entity? That sort of thing. Some basic troubleshooting stuff. And then beyond that, we've built out a new section around claiming reimbursement for federal grants, specifically for ESEA grants and IDEA grants. But ESEA grants technically have a lot more friction points and contact points than IDEA. So we spent a lot of time on building out some clear guidance of what we're looking for and how to, facilitate things going smoothly between you and I, between the IDE and the LEAs, pardon. So first and foremost, we start out with some general requirements, what we're looking for in terms of content in the supporting documentation and in the notes field. And then we get into some specific guidance of what content we need to see for things to be easily identified in the CFSGA and in the GRA. And then finally, we've got a content section about special considerations. And the hot topic there will be your food purchases. We've thrown together some in-depth guidance on how we would like to see reimbursements for food take place in the future. And this is in answer to some new non-regulatory guidance put out from USAID back in 2024, which we'll get into in a second. And then finally, the back half of a manual is outlining a step-by-step guides put together by some LEA volunteers of how to pull or extract specific documentation from each of the major accounting systems in use by the state in order to quickly and easily pull documentation that easily meets our needs. So if you're a user of Cumulative, I2M, or of Tyler, or School ERP Pro, whatever you want to call it, we have a hands-on guide for you. So if you're looking to see, okay, cool, all these pie-in-the-sky goals of what you want to see our documentation look like, how do I do it? That section's in the back end of it. If a software that you're using is not represented in the manual, like QuickBooks is our #1 wish list item right now. If you'd like to contribute to this manual and help us put together a section for QuickBooks, by all means, please reach out. We'd love to have your expertise as a resource for other LEAs, as well as for us to be able to see how to help new LEAs or new business managers get to that, a GRA flow state. So I'm going to touch on some highlights. This is going to be kind of an abbreviated version of our IASBO portion, of our IASBO presentation from a couple months ago. So if you've seen that presentation, you can kind of stare off in the distance for the next 5 to 10 minutes. But for everybody else, just some broad updates of the GRA. All GRA requests are able to be processed on a weekly basis now. If anything has been approved before Thursday evening, on Friday morning, it will be paid out to you. That does not mean we promise to have a 1-week turnaround on every GRA claim, but we can do our best. If you submit a GRA claim on a Thursday morning, wouldn't be unreasonable to expect that that GRA claim is likely to be approved that same day and be paid out the day following. But if you submit an absolutely a behemoth amalgamation of GRA of expenses from the beginning of the year until now, with all sorts of travel and supplies and purchase services and everything else, it may take a day or two to actually get through that, and it may be delayed an extra week. We'll also begin a new practice where In the event your GRA request requires further review from a coordinator, that's going to take more than a week, or we need to reach out to USED, we're going to notify you via email saying, hey, we haven't forgotten about you. We're not just leaving you high and dry. We're going to reach out to you directly and say, hey, here's what we're doing. Here's our next steps. Here's our timeline, that sort of thing. So just in effort to keep you guys in the loop and be more responsive to GRA claims. So for the general requirements of a GRA request for any ESEA grant or IDEA grant programs, we need to be able to identify that the expense that's being reimbursed is allocable, reasonable, necessary. Like the three main points of allowability. We have to be able to make sure that, or we have to be able to identify that the expense took place during the allowable period of performance, that it's in alignment with your grant application, and that all of the three above items are transparent and readily accessible to somebody that's reviewing the GRA claim. Now, the allowability, like a triangle at the top there, that first bullet point and the third bullet point are kind of intrinsically linked. If you're doing something that's very clearly in your CFSGA or in your IDEA application already, you don't need to write a whole encyclopedia out of what all is contained, especially if your documentation is nice and clear. So you ought not to feel like you're going on trial with every single GRA claim if you're doing things that are explicitly in alignment with your application. If your application is relatively vague, in those cases, we may ask some additional questions about, hey, is this being used in a 1A allowable circumstance, that sort of thing. So the more easily we can align what's in your application for reimbursement to your grant application, the easier time we're going to have. Also, I've highlighted an excerpt out of the new GRA manual at the bottom there in red. And what we're trying to express with that is that as long as we can identify all of the information we need out of either your notes field or your supporting documentation, it doesn't need to exist in both. So if it just so happens that the expense description for a piece of travel in your backup documentation, like in your expense ledger, mentions, hey, this is per diem hotel and registration for a Title 1A coordinator to attend the National ESEA conference. You don't need to write all that again in the notes field. You can just say PD travel for coordinator or something along those lines, nice and broad, and we can put the pieces together from your documentation. So if you feel like you're duplicating work, reach out to us and we can help you guys actually refine that individual, that section of your process. For supporting documentation, across the board, we always ask for an expense ledger with your GRA claim. We need to be able to see that the amounts that you're requesting actually took place in your application, in your accounting system within the period of performance. We're going to want to see a brief expense description, hopefully with more detail, but if it's relatively broad, that's when your notes field can come into play. We'd like to be able to see your accounting codes and your accounting system and make sure that you're claiming for the correct fund. If you request $20,000 in Title 1A funding, but you've requested against Title 4, everything in the claim is going to look correct except for the fact that you may have claimed for the wrong fund. Unless, of course, you're looking for transferability, which is a whole extra little thing, but we're trying to get communication across that everything's being done above board. One last request, when you're submitting expense ledgers, please do not include any asset, liability, fund balance, or revenue codes in your expense ledger. They are interesting and very cool, and we appreciate that you're showing them off, but they do not necessarily contribute to the efficacy of that expense ledger to show us what's going on. So please feel free to leave those out. It'll shorten the review process while we're not sorting through extra account codes. For anything that's under the salary and benefits category, we're looking to identify the job titles that are being covered. So if that's included in your expense ledger already, your detail ledger, that's fantastic. We can see that, yep, these are Title 1A paras. Awesome, easy as. If we just say, if the account description is just classified salaries or Title I classified salaries, and we can't identify what the job title is being supported or what all is going on there, we'll ask for extra documentation saying, yep, these are my paras, these are my coordinators, these are my interventionists, that sort of thing. Once again, just trying to tie out the expenses being claimed for reimbursement with the approved application. In the application, if you wrote, hey, I want to pay for 28 classified folks, cool, I can think of a dozen different ways that a classified para could, or a classified employee could be covered with Title 1A funding that may or may not be aligned with Title 1A itself. Like, you may be an intervention, like a para performing interventions. It might be a para working on a bus. It might be a recess duty. Like, we can identify what exactly is going on based on the description classified. So a little bit more detail is being sought out there. If it's PD events, we're looking for, once again, alignment with the application itself. We want to be able to identify what the training was so that we can dig into it on our end and say, hey, what was going on here? If you're going to a water park, it's probably worth mentioning, hey, this is for a STEM event for a competition. We're launching water bottle rockets with our team. We're not going out to just have fun. That sort of context is extremely helpful in these claims, so we can clarify things and get these funds to you. And if you're paying for mileage reimbursements for other employees or for parents of homeless students or your migrant liaisons or whichever else is the case, please let us know who the recipient of these who the recipient is of these reimbursements, so we can, once again, align it with your application. If you're using very similar language to what's in the approved application, you're going to have a really easy time. So all that's kind of like the bread and butter stuff. The big burning question, food expenses. So USAID put out some guidance back in August of 24, I mentioned earlier, that outlined what USAID saw as 4 explicitly allowable scenarios in which food may be purchased with federal funding. And all 4 identified scenarios were for PD events or parent engagement nights or day-long meetings that were also sponsored with grant funds. So those 4 scenarios are named here. Food costs at a family engagement event. That's been something that's not news. You could always buy a pizza or buy whatever easy, reasonable cost food items for your parents attending a parent engagement meeting, a PAC meeting, a Title I night, whatever you brand it as. That is and was fine. If you're working if there's a day-long meeting where you're doing an all-day training that's sponsored with Title I, Title II, whatever program is sponsoring it, that meeting needs to be a day long in order to actually justify a working lunch, and a working lunch has to actually demonstrate that there is some content being discussed in that working lunch. It's not just, hey, we could just send you guys out to grab food, or you're going to eat lunch on your own, whatever else. There's actually some value gained with the quality of the training by working through lunch, and we're going to feed you during that time. Light refreshments at an after hours meeting. If you guys are staying late during like a JPass meeting or a Title I night, and it's just a coordination of services, a data analysis meeting, whatever you guys are up to after hours, that's a Title I or title aligned program. That is generally fine. And then snacks at a day-long meeting, same threshold as above. If you're at a day-long PD event, whether or not you work through lunch, you can serve snacks or serve refreshments during the day. Obviously, alcohol is still unallowable, as much as I would like to consider that a snack during a PD event, but that is still out of the cards. So if we're going to seek reimbursement for those items, we need to see a little bit extra documentation. And this is additionally burdensome. That is obvious. But this is a piece of infrastructure that we've created to meet the new non-regulatory guidance put out by USAID saying, hey, food costs are not generally ordinary and necessary to improve student outcomes or to enhance the quality of your staff. If you're going to do this, you need to demonstrate that one extra step, that this is actually essential to the operation of your program. So to answer that, we're looking for a little bit of extra information. If you're buying food, we want to know what was purchased. Like, was it burritos in a food truck, or did you get a barbecue company to go out and cater ribs for everybody? Like, what are you guys up to for food? What event was it associated with? What's the purpose of the food cost? Like, why are we feeding people? Was it a working lunch? Are we trying to attract parents to a parent engagement night? Are we working through a meal? What's going on there? And then if you're using a program set aside like homeless or something out of Title II, please identify that so we can use the appropriate allowability lens. And if you're doing any of those 4 scenarios, we're looking to see a attached agenda for the event so we can see that the event was in alignment with the program. And we're also looking for a sign-in sheet to demonstrate that whoever was supposed to be there actually turned up. if we're saying hey, we held a parent engagement event and we fed everybody there and a sign-in sheet's turned in and there's not a single parent on the list, like, are we just having an after-hours party to celebrate our migrant program? Like, what else is going on there? So yes, this is more burdensome than we've previously asked for. The counterpoint, the idea there being U.S. Ed's more thoroughly scrutinizing this point. If we're going to continue to do this, we have to be able to defend it every single time it comes up. If we're not able to do this, or we don't want to jump through these hoops, the other alternative is we locate some general fund budget or some other program budget that can cover the food costs, and that way we're not trying to meet with these very strict allowability rules. So if you're going to do a all-day meeting, there is some additional restrictions on what is classified as an all-day meeting. The meeting must be at least 6 hours in length in general. That's for the snacks and for the working lunch threshold. And if you are going to be a working lunch, you do need to have that agenda that says, hey, this section of the agenda was reserved for this activity or X and Y activity that contributes to the overall purpose of the event. It can't just be a socializing, a meet and greet section. You want some actual core content being discussed in that or alluded to, or some activity in there that actually justifies the working lunch. I can't say how strict we'll be on that just yet. We'll evaluate on a case-by-case basis. If it's an obvious attempt at justifying a working lunch where one wasn't necessary, we may throw up some red flags and talk to you about it. If it's something that's clear as day, you were trying to squeeze as much content as you possibly could into a 6-hour or longer meeting, we'll let that through just fine. So, okay. So, GRA requests have some new standards. Those standards are actually going to take effect on July 1st. So everything you claim from now until July 1st is against the old standards. We're going to do our best that if we see any GRA claims that come through that are currently up to standard but don't meet the new ones, or there's some vagueness going on, that we're going to stop accepting as readily. We'll be able to approve the GRA claims, but we'll try to include a note saying, hey, this is approved, but bear in mind some caveat or some item of this is not going to be as acceptable in the upcoming standards. Or, hey, you're doing too much work. Here's the new standards that you can be working off of. So, and actually, in a lot of cases, while we're reviewing GRA claims, we're identifying items that folks are doing that's above and beyond what's necessary already. So hopefully the new written standard kind of lets everybody know, hey, there's some more freedom than you think there is. Here's what we're looking for. You don't need to do all this extra work beyond what we're looking for. So, okay. GRA manual out of the way, we're going to pivot to excessive carryover. So this is kind of a abbreviated version of a presentation that we'll be doing in the CFSGA workshops about the new enhancements and new features in the CFSGA. But this one is worth discussing in a setting around business managers because it will be affected by the behavior of the district around the GRA. So, and it's the GRA mixed with how carryover is measured. So, a carryover is a term that's explicitly tied to a Title 1A. Section 1127 of the ESEA Act states that only 15% of a given year's Title 1A allocation may be obligated in the secondary period of availability after the first 15 months. So what that's saying is you've got 100% of your grant funding. You have 27 months to work with this funding. 15 months is the period you have to spend at least 85% of it, and then that remaining 15% can be used in the remaining 12 months. So the relevant dates most of the time are going to be from July 1 until the following October 1st, like through September 30, and then from October 1st through September 30 of the year following. These do not line up with our fiscal years. There will very rarely be any kind of audited financials based around the date of 9/30. So our accountability measures for asking for carryover were kind of flawed in the past. We have, in the application in a lot of LEAs, there was a lot of intermingling of the term remaining grant balance and carryover. When we exited one fiscal year on 6/30 and began a new one on 7/1, the term carryover was often used to describe the amount of your grant balance that was still available. and we tried to apply that 15% threshold to the amount of funding that was still available after that audited date, and that's incorrect. A carryover is not measured at all until that September 30, October 1st threshold after that first 15 months. So that's going to affect, or that requires a bit of a pivot in the CFSGA, which we'll get into the CFSGA workshop, but we on our end need a way to be able to measure the amount of carryover held by an LEA. So to that end, Title 1A has an enforcement measure where if a subrecipient of Title 1A tries to carry over greater than 15% of their of a year's allocation after October 1st, then a fiscal penalty may be assessed. Or we can issue a waiver of excessive carryover from the state. So in essence, the first time that this happens, we as a state have the authority to say, yep, that amount of carryover is allowable. You can file a waiver and say, yep, here's why we have excessive carryover. We can approve it. And you go on about your merry day. Whatever funding you had left is whatever funding you had left, and you keep your current year allocation totally intact. However, in the event that you carry over more than 15% after that 15-month period, more than once, after that first instance within 3 years, after that on that second instance within 3 years, a 3-year period, we are then obligated to carry out some enforcement action. And in essence, that the carryover, the enforcement action there is to take whatever the amount of your excessive carryover was and remove it from your current year allocation. So if you're only allowed to have $20,000 of Title 1A on October 1st of 2025, and you actually carried over 25% until that date, then we're going to remove $5,000 from the 2026 allocation just to make up for that difference. So if we're going to carry out enforcement action, then we had best bet that our measurement practices are actually squared away. We don't want to be, accusing LEAs of having excessive carryover if they don't actually have it. And we also don't want to be able to just say, hey guys, just feel free to self-report your carryover balances to us, because we want to be able to communicate what carryover actually is, and if all of our accountability mechanisms are based on self-reporting, that requires fluency. And what we saw with the previous system, if you remember the current year system for excessive carryover, we're asking for LEAs to self-report what their carryover is, and when we audited that number based on GRA activity, we found that instead of just the one LEA that had excessive carryover for the second time in 3 years and self-reported, yep, this is going on, we're going to accept the fiscal penalty, we ran an audit through our GRA and found that some 18 LEAs were actually carrying over additional funding for the second time in 3 years. So we've adjusted our practices and said, okay, our carryover measurement is now, starting in the 26-27 school year, going to be based on what your GRA balance is as of 9/30 of each fiscal year. So in the CFSGA itself, it'll show a 0 GRA balance up until we hit the September 30 date. Once we hit September 30 date, whatever the amount of available funding in Title 1A is going to be sampled. Meaning, if you have a pending GRA claim, that pending GRA claim is going to count against the remaining grant balance. So you could have a GRA claim pending that hasn't actually been paid out yet, and that'll still count. Basically, if the amount that's remaining in the GRA as of 9/30 is less than 15% of the funding you received in the year previous, then your carryover is fine and we don't care. We're going to move on with our lives. You get to just completely ignore anything about excessive carryover for that year. You're covered. In the event that your carryover is greater than 15%, then we begin follow-on actions. So basically, I consider that first sampling method an initial screener. Say, hey, do we need to have a conversation about carryover yet? If it's below that, nope, we can just keep living our lives. If yes, then we're going to chat with you about what next steps are going to be. If you have too much balance on 9/30, we're going to chat with you and find out, hey, what's the value of your unreimbursed expenses? We know there are something. We know there's something. You cannot possibly have claimed your expenses from the month of September before the end of September. That's not how like reimbursement basis works. You have to have completed the entire period of performance to get that done. So the first question we're going to ask is how much have you not reimbursed from September? And then are you totally caught up on your drawdowns, or are there any months or any expenses that were left unreimbursed for the preceding period? Or additionally, since we're in an active fiscal year, are there any expenses that took place between July 1 and September 30 that you could have charged the Title 1A and are allowable and are in accordance with your current year application that you haven't drawn down yet, or you could shift over and draw down? So we're going to work with you to see how low we can get this balance to. In the event that we've got to work with you and get that balance down and it's still not enough to be below the carryover limit, that's when you'll request an excessive carryover waiver in that year of the CFSGA. So that's the process we got to go through each year in order to make sure, hey, if you have kind of a preliminary warning on what your carryover balance is, I'll have a conversation with you, see what the number actually is, and assess at that point if we need a waiver, or if it's happened more than once in 3 fiscal years, what's our enforcement action going to look like?
Hey, Austin, we have a quick question. Are
Yes,
there
sir.
examples or formulas to help with this carry forward calculation in the new GRA manual?
In the new GRA manual, there are not, but there are or ought to be in the CFSGA manual. And actually in the CFSGA itself, it will have written what the formula is for your carryover. It will be the totality of your entire current year allocation. So whatever your 25 allocation was, if you transferred any funding into Title 1 from Title 5, so if you added in your Title 4 allocation, if you added in your Title 2 allocation, you're going to add that number in as well. And then whatever that number ends up as, you're going to multiply that number by 0.15, and that's your carryover limit. You can't go below that. You can't go above that, rather. If you are approaching that carryover limit, you may be able to manipulate that number a bit by changing your plans and not transferring some 2A or 4A funding and lowering your carryover limit, so you can make that. Actually, that would be the other direction. You don't want to go that direction. You may be able to transfer Title 4 funding or Title 2 funding in to be able to raise the threshold and skirt under that line if you'd like to. That's the direction I wanted to go. Sorry, caffeine isn't quite kicked in for the morning. So the formula is relatively simple. Just whatever the current year allocation is times 0.15. The CFSGA will demonstrate for you what that carryover threshold is the minute the CFSGA is populated. So it'll give you your number that's your target right off the bat. So what's the change? What's the deliverable? What's the change in behavior that's going to enable this to be easier as an LEA? In essence, this is going to put some emphasis on your GRA management. If you are one of the many LEAs that lets the GRA breathe, put that lightly, and say we're going to leave it alone for 6 months at a time, and then all at once we're going to claim all of our GRA, all of our unreimbursed expenses in like March for everything that happened since July 1 through the beginning of the year. Since your GRA balance hasn't been updated in a while, we're going to pretty constantly flag you for, hey, your GRA balance is too high, what's going on? In the event that you've caught up on at least July and August of your reimbursement claims, that's less likely to take place because you've demonstrated, hey, we're relatively caught up, we're fine, you can get under that early screener threshold and not worry about it. Additionally, if your spending habits enable you to just get below 15% naturally, just make sure whatever amount is required to get below the 15% is already claimed, and you'll be fine at that point. But the appeal process, in the event that you are behind on your drawdowns, the appeal process is just to make the GRA requests. So if you say, hey, I've got $25,000 of unreimbursed expenses, and we're like, all right, well, your carryover is high by $20,000. If you make that claim, you're good. All you have to do is go into the GRA, begin that claim, and then give us the claim number in the supporting documents tab of the application, and you're fine. So staying a little more up to date on the GRA will keep you basically out of hot water. I've heard some discussions from the higher level folks here that encouraging LEAs to be more up to date on the GRA is kind of well received. And don't get me wrong, I understand that the summer period and the fall specifically can be hectic. Like right when you're in the middle of an audit, it can be a pain to try and put together a 3 month or 4 month drawdown request, even if it's just for Title 1A, just for the sake of ignoring some headache in the months coming. So if you need to skip a month or two in order to be able to consolidate that and get some breathing room, by all means do that. We're just hoping to have some sort of GRA claim placed before September 30 to keep you out of the doghouse just a little bit. So the best practice from my end, at least in my experience and from chatting with some other business managers, the ideal way to kind of manage Title 1A to keep yourself receiving funding from the GRA on a periodic basis and without having to really worry about this 15% threshold each year. Unfortunately, this doesn't give you the most amount of flexibility when it comes to what your carryover is, but if you're targeting every single year, if you're planning to spend 85% of your current year Title 1A allocation and any carryover in the 12-month period from July 1 to June 30, as in your audited financials are going to include expenses for 85%. After that point, you've got 3 whole months of extra expenses you could toss in if you need to, if you fall short of that target. So if I'm aiming for 85%, and I have some turnover, I have some positions not get filled, I had a vendor back out the last time, I've got extra funding I can't get spent down. Now I'm not trying to panic and find a way to spend a bunch of my money. I've only got to make up for that difference of whatever I fell short of 85% as. And I've got 3 extra months of expenses of summer school, of summer accruals I can throw that money at, and it'll be okay. If you're planning on using the entire 15-month period for 85% and you fall short of your target, you've got really no real space for remediation. So having that extra 3 months of breathing room is not a bad idea. And you could also say, well, why not target the whole 100% in the first 12 months? So not saying every LEA, but a significant number of LEAs have some back and forth when completing their CFSGA. And it's sometimes nice to be able to access the GRA for cash flow in the meantime while you're waiting for your new allocation to arrive. So that extra 15% that you've left in there deliberately, that's in your current year 27 or in your 26-27 budget, you can access that funding out of the GRA before the CFSGA has been opened up. So you can keep your cash flow moving and keep your cash balances happy even while you're trying to get your CFSGA approved. If you're trying to get your CFSGA approved so you can make your cash balances happy again, that kind of layers the whole application process and some extra anxiety that's not necessary. So this practice is what we see is kind of a good idea. If you can't get to the 85% target, just wrap up all the unreimbursed expenses you can into a GRA claim before 9/30 to try and get as close to that threshold as you can. Beyond that, we're going to be visiting this more deeply in the CFSGA workshops. By all means, reach out to me with any further questions. And thank you guys for your time.
Thanks, Austin. Appreciate the additional information. Well, folks, appreciate your time today. Hopefully this was very helpful for you all. We've got our contact information for the SPED folks and then our federal programs people. But at the end of the day, thank you for what you do for the state of Idaho and for the children. So hope you all have a wonderful April, and we'll catch you next month. Thanks, folks.